Morning, everyone. I'm Alain Durré, the new head of EMEA macro research at Natixis CIB. For me, it's a real pleasure today to have the opportunity to exchange with the ECB Vice President Luis de Guindos. So the objective of this debate is really for you. So the idea is to be as interactive as possible. And therefore, I encourage you, as from now, to ask your questions in the Q&R chat box. And I will, of course, ask those questions to Vice President de Guindos. So let me first thank you. So dear Luis, thank you very much. It's always a pleasure to exchange with you. And I know your agenda is very busy, so I really appreciate that you kindly accepted my invitation. That will be the opportunity to exchange views and your sentiment about the key economic issues, and of course, to debate with our participants. Well, if you agree, let me first start by saying that, well, the Governing Council met last week. You, with colleagues, decided to keep the key interest rate of the ECB unchanged. My first question will be how was the mood, and what your perception currently about the way forward?
First of all, good morning to everyone. Thank you very much, Alain, for this invitation, and Natixis. It's a pleasure to be with you and to have this exchange. I hope that you can hear me.
Yeah, wonderful.
Very good. Well, the last meeting last week in Florence of the Governing Council, I think that it was totally consensual in the sense that we decided, as you have said, to keep interest rates, and as you know perfectly. And here, perhaps a couple of notes to give a little bit of color to the discussion that we had. First of all, with respect to growth, we were marginally more optimistic than in previous meetings. While the resilience of the European economy is there, we have seen that the growth rate in the third quarter, according to the flash estimate of Eurostat, has been 0.2, with disparities. And this is something that we will have to. I think that is something that is relevant because 50% of the GDP of the euro area, Germany and Italy, is flat, whereas in the rest, is growing a little bit faster. But 0.2, I think that is an indication that for the whole year, our projection of a growth rate above 1%, that is not brilliant, but it's not a recession. So I think that is a bittersweet sensation. But our projection is going to be met, and that growth rate will be a little bit above 1%. And we can talk afterwards about the concrete elements that, in our view, have given rise to this outcome. On inflation, the news are positive. Headline inflation. I'm not going to repeat what you know. Let me say only that we are much more optimistic with respect to services inflation. Services inflation, that was one of the main problems that we had, a couple of quarters or 1 year ago. Now is behaving much better. It's decelerating to 3%, and simultaneously the evolution of wages, is also fully aligned with our projections. So all in all, we decided to keep rates. We believe that the present level of rates is the correct one. We are following three indicators that determine our monetary policy stance. The first one is the evolution of inflation. The second one is our projections on inflation that clearly indicate that we are going to be hovering our price stability target of 2%. And finally, the transmission of monetary policy. The transmission of monetary policy, for households, is quite obvious. There is an increase in the demand for mortgages and a reduction of the cost of mortgages. In the case of the corporates, it's a little bit more complicated, the interpretation. Why? Because, it's obvious that there is a reduction in the cost of the funding, but simultaneously there is a tightening in terms of the acceptance of the European banks. So even the demand for credit is not very strong. So in the case of households, it's clear that our monetary policy is transmitted. In the case of the banks, and I think that it's not related to monetary policy. What we have seen is that the demand for credit and even the approach of the banks to lending to corporates has been affected by the geopolitical risks and the perception that perhaps this geopolitical risk might affect the solvency of non-financial corporates.
Yeah, and precisely in terms of the balance of risk, what is the view of the Governing Council you discussed last week between the upcoming risk that did not materialize yet? So basically lower than expected energy prices, non-tariff trade elements, was it the view of the Governing Council that in the end those risks will be more than offset by the fiscal boost we expect from Germany, or then you believe that we are still not yet there and there is still an issue for being remaining vigilant?
Well, with respect to growth, as I have told you, we are a little bit more optimistic than we were. So, the risks now are much more balanced because, there are some elements that, are boosting growth and fostering growth. But the level of uncertainty is huge, as you have indicated. Well, the trade agreement between the US and Europe has been settled and finalized. Is again a bittersweet, outcome in the sense that we have avoided an elevation at trade war that would have been extremely detrimental to Europe, but simultaneously the level of tariffs for the European products in the US, as you know perfectly, has been raised to something close to 15%, 13.5 according to our calculations. No. So, this is another element that it has reduced the uncertainty that we have. Simultaneously, there are other elements that we have to take into consideration. Geopolitical risk continues to be there, the situation of Ukraine. In the case of the Middle East, there is a clear improvement. And simultaneously, for us, the settlement of the trade agreement between China and the US is going to be key. Because we can have some trade diversion implications. So, it's not only, the bilateral agreement between the US and Europe. Is as well, we needed to have a holistic approach with respect to the trade agreements. And finally, another element that we will have to take into consideration is, the tremendous increase in competitiveness of Chinese products. And how this is going to have an impact on growth and inflation in Europe.
Yeah, so we, according to our calculation, if we keep, we replicate the ECB model for inflation, and we put exchange rate at 1.1819 US dollar and $60 US dollar for the Brent. We have basically 0.2 percentage point lower this year, next year, and 2027. So then far from the target. So the question is there a psychological barrier for most members in the Governing Council not willing for any reason to go below 2%, or you will say that the next step, if there is a next step, will be more likely a cut than a hike?
Well, it will depend on the data that we receive. We are data dependent. The level of uncertainty is very, very, very high. But let me say something. I think that so far, and given the recent evolution of inflation, our projections, I think that we can be comfortable with the level percent of interest rates. No, so things can change in the future, and there are some risks. Always, you have risks, and you have some elements that and some circumstances that can change. But the present level is the correct one. You refer to the indirectly to the possibility of undershooting our target. Well, we do not believe that this is going to be something that is going to give rise to any permanent reaction, because the undershooting, if it happens, it will be something that is going to be temporary. So our projections, it's impossible to be at 2% continuously all the time, but you can have some some levels a little bit above, a little bit below, but in general terms, I think that the convergence to the 2% without any overshooting or undershooting is now, the baseline scenario for our projections.
And this brings me to the questions about the exchange rate. At least in the account of the monetary policy meeting of September, there is a very prominent discussion about the evolution of the exchange rate. If you allow me, during the summer, you even mentioned the threshold of $120 for euro per euro being problematic or concerning area. Where do we stand now? Because the combination with potential lower energy prices, decelerating wage growth, and tightening of credit conditions, that could be a configuration that you don't like to. How is your view about the exchange rate shared by the council member?
Well, the exchange rate is a very important and relevant macroeconomic variable for Europe, because Europe is a very open economy, as you know perfectly. Well, I'm not going to repeat what we always say, that, I'm going to repeat it now, that we do not target the exchange rate. We do not have any sort of threshold. I think that we pay much more attention to, to the speed of the evolution of the exchange rate, because this is something that could create, more uncertainty. But let me say something, remember that at the beginning of the year, the majority of the analysts believed that the exchange rate would go to parity. And afterwards, some months after that, now, the risk was an excessive, appreciation of the euro. Now, you know perfectly that, the exchange rate has been settled around 1.15. And, this is something that we are taking into consideration. So, so far, what I would say is that, the exchange rate is not giving rise to any sort of additional preoccupation in the governing council. And we will pay attention to this variable that is very relevant for Europe, but simultaneously we do not have any sort of concrete threshold that could give rise to any sort of reaction. We do not react to the evolution of the exchange rate. We take note of the evolution of the exchange rate, but we do not target the exchange rate.
And I guess what matters is not only the speed of the evolution, but also the origin. If we have an appreciation which is not related with the growth prospect of the euro area, that's more problematic than just over.
Yes, you are totally right. It's whether the exogenous forces are driving the exchange rate. Is something that and I think that it has been the case. The exchange rate has been driven by, the negotiations about tariffs and the policies in the US and in other jurisdictions. So, but we do not try to compensate that kind of things.
Yeah. If you allow me, I pick up one question from participants, which is basically, how can, just reading, how can the ECB committee justify a rate, an interest rate on the deposit 2% with such a low growth across major euro economies and without any indication of inflation pressure? So basically, so then what do you see there? Because One way is that in the context where other major central banks are more entering in a more accommodative mode, I will say, the question here is to say that is there not a risk that the ECB is a bit not synchronized or out of the global cycle?
Well, as you know perfectly, Alain, our primary mandate is price stability, and price stability defined by, an inflation rate of 2%, and this is our main object. And simultaneously, we'll have to assess, the potential risks that, in the case of inflation, as I have said before, are two-sided. And and growth. Well, growth is better than many projected only, a couple of quarters ago. So the European economy is showing a little bit of resilience. But let me say something. I think that, sometimes we look at the average of the growth rate and the average of the different macroeconomic variables. But here, I think that we need to start to pay attention to the heterogeneity of the growth rates among the different countries. To have a little bit of dispersion around the average is something that is totally normal, because the economic structure of the different economies is not identical, as you know perfectly. There are some of them that they are much more export oriented, and others that are much more, the net exports are not so relevant. But I think that when you see the disparities now, because you have Germany and Italy flat in the third quarter growth rate, quarter on quarter, and other countries with positive growth rates. And it's important to analyze. One quarter doesn't make a trend, as you know perfectly, but simultaneously we need to know and to understand better what's happening there. What are the reasons of the disparities in terms of growth among the different countries?
Yeah, and then that brings me to the other leg, I will say, of the monetary policy, which is the quantitative tightening. So we saw that the Federal Reserve decided to stop its quantitative tightening. We saw that Bank of England is reducing the pace. Well, as we both know, that we can possibly to keep the key policy rate at 2%, but increasing liquidity in the system to depress the credit conditions, and also to have Esther lower, which is the effective money market interest rate. So what is our view about the likelihood of, two questions. So what is your view first on the likelihood to reassess the speed of the quantitative tightening of the ECB? And the second question is, with the view to have the announced structural monetary policy portfolio, the question is, despite the quantitative tightening, will we remain in excess liquidity mode for a considerable period of time?
Well, first of all, let me say something, for the sake of clarity. We have not discussed anything with respect to QT or any modification of the QT that we decided some time ago. Now, on average, because it depends on the maturities of the securities in our portfolio. Our portfolio, our balance sheet is reduced by something on average close to 40 billion per month. So that's the situation, but we have not discussed anything with respect to that. We always say that our main policy instrument is the modification of interest rates, and QT, is something that is a sort of a complement to that. But we have not discussed anything in the governing council. Second, I think that the situation of liquidity of the market in the euro area continues to be, of abundant liquidity. There is not, we have not seen any sort of, let's say, potential implication in the different markets, in the repo market, in the cash market, of the policy of our policy of QT and the reduction of our balance sheet. So far, even if you look at the situation of spreads, is not giving rise to any concrete problem. So our perception now is that there is a situation of ample liquidity, that QT is going to continue, and even I think that we have not started. I don't know when, but we will have to discuss it in terms of the structural portfolio. That is something that you have indicated. But the structural portfolio, well, we will have to make some calculations. But so far, I could tell you, and I think that in the near future, the situation of ample liquidity is something that is going to be there, even with the reduction, with the rundown of our portfolio in terms of 40 billion per month.
Okay, and but then another question I have here is that there is so it's basically a self-sustained consideration for the euro area. So meaning that you don't necessarily look at what happens in the US or in the UK, right?
Well, it's totally right. The situation, we have to look at the situation of our markets. Well, always you have, you know perfectly that, all the, we are living in a global market, especially, on finance. But, for instance, in the case of the UK, the maturity of the securities that they have in their portfolio is different from ours. In the case of the US, is, a different context. For instance, in terms of the tensions in the different markets. So in our case, we have to look, namely, to the situation of our markets, and to the liquidity situation of the markets, and markets continue to be liquid. And if you look, for instance, the most obvious market, that is, the current bond market, even the situation of spreads is very quiet, it's very smooth. We have seen, a reduction of spreads, for many previously problematic countries, and I think that this is a good indication that the situation of liquidity, that our QT policy is working properly.
Yeah, and okay. So now, if you allow me, let's turn to precisely the fiscal stance we have in the euro area. So we have elevated levels of public debt across the euro area. How do you see this situation, and to which extent you think that at some point that could be a constraint, that could become a constraint for the monetary policy?
Well, with fiscal policies, it's part of the aggregate demand policies that we have in place, monetary plus fiscal. So we always consider, the fiscal stance of the different governments. That's something that is obvious, something that we have to look, because it could have, an influence on inflation and growth. I think that now, if you look at the situation in Europe, first of all, I think that fiscal issues are not only, circumscribed to Europe. Look at the US. The US, the fiscal deficit is very high. Even the public debt ratio is above the European average. But going to the situation of fiscal in Europe, I think that there are two elements that we have to take into consideration. The first one is that we need, and this is a priority, it's an existential priority, we need to increase, defense spending. Our commitment in NATO is to go from 2% of GDP to something, that, a first stage will be to reach 3.5, and afterwards to 5 in 2035. So this is something that we have to increase, and I repeat again, is the consequence of the need to increase the autonomy and the dependency of Europe vis-a-vis the US, in terms of defense, and given the threat that we have with Russia and the situation in Ukraine. So this is one element, and the second element that I think that is important to bear in mind is that political stability is key. I can tell you about my own country, about Spain. Spain, even though, the deficit is hovering around 3%, Spain has not been able to approve a budget since 2023. because the government has not a majority in the parliament in order to pass the budget. And these are the two elements that we will have to combine. I think that and simultaneously we will have to deliver a very clear signal that we are going to respect the fiscal framework that was recently approved for in Europe by the Commission and by the Council. So these are two elements that could give rise to some issues, and simultaneously we have to send a very clear signal. So far, fiscal is not giving rise to any sort of, let's say, problematic approach from the market standpoint. The situation of the government bond market is very quiet, but you know perfectly that markets can be quiet, and sometimes they start little by little, step by step. They can change rapidly about that. And let me say something simultaneously. This is the implication or the impact of fiscal on the macroeconomic stance. We always consider that a higher public deficit is going to foster and to boost demand, and is going to be growth positive in the short term. But we have started to see that the situation of fiscal and the situation of deficits and public debt is having an impact on the attitude and the performance of households and consumers, in the sense that they start to discount that in the future some governments will have to raise taxes or to reduce welfare spending, and so the reaction of households is to increase the saving ratio. This is something that is important, because consumption is going to be, according to our projections, should be the main driver of growth in our projections. And this is not taking place. There is a recovery of consumption, but it's a very muted recovery of consumption. So to use a traditional fiscal language, perhaps there are some Ricardian equivalence effects. It's not only the traditional approach that fiscal a fiscal expansion boosts the aggregate demand. Perhaps here, in some countries, the situation of fiscal is having, an impact in terms of moderating, the consumption and maintaining the saving ratio of the households higher than it was initially projected.
But yeah, and precisely that brings me back to the previous discussion, where basically clearly we, in countries like France, for instance, where you have political instability, we have the highest ever saving rates at 19 basis points. And despite the high level of saving rates, people also, surveyed people, continue to say we intend to save more. So that brings me to the growth outlook scenario, the scenario for growth outlook, because again, in the account of the September meeting, it was clearly stated that the prospect or the GDP growth forecast in the ECB staff projections, there was the assumption that basically we will have a decrease of saving rates to boost also consumption. But at the same time, the question here is that we see fragmentation across the Euro area countries on both sides. So the first side is, as you said, the situation of the fiscal stance and public finances weighing in most countries on consumer confidence and private consumption prospect. And on the other hand, we also have the diverging evolution in the housing market. So then, in case of market stress or stress on the sovereigns, which is the basis for pricing the credit to households, how do you see the situation? What could be the line of defense? Would be the QT? If you can also remind, this is a question I have about the activation of TPI. What are the key criteria? So that's what do you see those elements?
Well, let me say something, because there is a bright, very important spot in the euro area, that is the evolution of the labor market. The unemployment rate is very, very low. It's an all-time low, as you know, since the inception of the euro. And even though we have seen some signals of moderation, employment creation is going on. So this is something that is positive. So, the logic of the evolution of consumption, according to our projections, is that the good evolution, the good performance of the labor market, plus the decline in inflation is going to give rise to an increase in the real incomes of households, and that should foster and boost consumption. But this is not taking place, at the rhythm that we projected. Why? And here there is, some confidence issues. Perhaps it's the geopolitical risk. Perhaps it's the situation of the fiscal and the potential recurring and equivalence effects that I mentioned before. But we believe that sooner or later, this impact of the positive evolution of real incomes of households will give rise to an increase in consumption and to a moderate reduction of the saving ratio. So this is something that I would like to indicate, and because we have been projecting a recovery of consumption that is not taking place with the intensity that we forecast. You refer to something additional that, in my view, is important, is the housing market. And the situation is a little bit of a contradiction, because you have an important increase in the prices of residential real estate, and simultaneously you see that construction is not moving upwards, and the activity of construction is quite moderate. And I think that this is creating some important social problems. And well, construction will take time, to start and to kick off, as you know perfectly. But I think that perhaps the main problem is not in the property market in the sense of the ownership of the houses. It's much more the rental market. I think that well, what's happening there? What's happening in the rental market? If you start to see, the evolution of rents, they are on the rise, and I think that it's very important to analyze, the regulation that we have in place, because perhaps we are, impairing the supply of housing in the rental market, and this should be, the first buffer to try to absorb and to try to reduce, the situation of the property market. No? So I know perfectly that the European Commission and the Council, they are very worried about that, because this is having, social implications, especially for young people, that they could not find. And simultaneously, I think that this is related to another, let's say, controversial topic, that is immigration. Why Spain is growing so rapidly? Because there is an important increase in the population responding to well, perhaps in Spain the situation is a little bit better, because immigrants come from South America, and they are very similar to the natives in terms of the language and in terms of the culture, and something that is much more accepted. But the evolution of immigration is giving rise to an important increase in Spanish GDP. Well, the GDP per capita is another variable we'll have to take into consideration. And simultaneously, these immigration flows are putting pressure on the housing market. That's why, and I think that the rental market is the one that has to absorb this impact. No? So these are elements, and I think that we talked about sometimes fiscal space, but I think that we have to look as well to the political and social situation, to understand potential problems that we might have in Europe. I am totally in favor of immigration, orderly immigration. I think that is necessary, given the demographics that we have in Europe. But we have to do it, with the correct way and with the correct approach.
Yeah, and precisely as you said, immigration, in the context of aging population, will allow to boost potential growth. We know that we have some difficult discussion at the political level about immigration in many countries. So then the question is, what is the trade-off in terms of monetary policy? Because with the new strategy of monetary policy you released last June, basically there was a lot of emphasis on the medium-term orientation, and then we could have in the short term a surge of inflation through a spillover of the substantial increase of minimum wage in Germany to the rest of the economy, possibly on other countries. We will also have the impact from ETS, but in the long run, as you say, in that if in most countries we will have a decrease of population because we have reduced immigration, then potential growth will be lower. So then, where do you place the medium term and the consideration short term versus long term for inflation?
Well, let me say something that I suppose that it's a sort of, contradiction from a central banker. Monetary policy is not almighty. We cannot address all the problems of the world. We can address, the problem of inflation. We can address situations of financial stability, stress. But there are structural issues in the economy that can only, be addressed with the structural reforms. And with, fiscal policy, and fiscal policy has implications in terms of potential growth, as you know perfectly. So I agree with you. We have a demographic problem in Europe, an aging population. The demographics without immigration flows will give rise to a reduction of potential growth in Europe. That is not very high, as you can imagine now. So it's something that we have to take into consideration. But I think that the solution of this kind of situations is in the hands of the much more of other kind of economic policies. Is monetary policy has to take it into consideration, but we cannot offset those kind of structural tendencies and trends in the economy. And let me say something simultaneously. I think that what can we do to improve potential growth? Well, we have the Leta report and the Durré report that I think that are quite transparent in that respect. But I think that, for instance, the completion of the single market, the integration of goods and services, because we talk a lot about the completion of the capital markets, of the capital market union or the savings and investment union. But I think that is very difficult to have a capital market union if we do not have, let's say, a much more integrated single market for goods and services. I think that the main factor that is going to foster the integration of capital markets is going to be to have a real single market for goods and services. And simultaneously, we have the situation of the banking union. We do not have an EDIS, common insurance deposit scheme for Europe. And I think that these are elements that for sure could improve if we put it, the Council and the Commission put in place the correct policies, could foster potential growth in Europe. And simultaneously, the question of immigration, because given the demographics and to change the demographic trend, as you know perfectly, is very difficult. It takes a lot of time. And so, the only short-term fix is to have an orderly immigration in order to try to compensate, the demographic trend that now we have naturally in Europe.
And precisely because if the ECB in the long run cannot solve all the issues, I fully agree with you. You are to some extent constrained by other stakeholders like the governments and the economic policy in the countries, does it mean that you could consider that the monetary policy stance will be in good place in the medium term without being in the optimal place?
Well, you
I
know,
tried.
I don't know what medium term means. What do you mean by medium term? But I can tell you that, you know, because now, given the level of uncertainty that we have, you know, in the world economy, I think that, well, we have to be focused mainly, you know, in the short term. And in the short term, I can tell you that, you know, the level of interest rates is the correct one, and that our monetary policy stance is the right one, according to the evolution of inflation, projections of inflation, and the transmission of monetary policy.
But then, of course, a lot will be conditional to the December projections, right?
Well, in December, we will have new projections, but so far, I can tell you that, you know, our projections, you know, seem quite accurate, that the real data that we are receiving, you know, dovetails quite well with our projections. So, you know, I think that this is something that is reassuring, no? But in December, we will have new projections and we will decide accordingly.
Thank you. I remind everyone that you can still ask questions through the Q&A chat box, so don't hesitate to ask your questions there. Maybe one last question on this topic before moving to the last topic is about, well, again, in case of market turmoil, can you just remind us the conditionalities for activating the TPI? But if both solutions are possible, so a sudden reducing the pace of QT, if not reopening the QE questions or the TPI, what will be the sequence there, the sequencing according to the market tensions we may have?
Well, you know, the question is that we do not have a lot of, you know, a lot of stress in the covered bond markets. Even, you know, you have seen that the usual suspects 10, 12 years ago, they have a lot of upgrades in terms of ratings. You know, I refer to Greece, I refer to Portugal, Italy, Spain. So, you know, now the situation. And even, you know, if you refer, you know, to the downgrades of France, the situation of, you know, in terms of spreads is quiet. You know, we have seen a widening, but you know, the levels are, you know, I would not say that can give rise to any sort of you know, of preoccupation from you know, the standpoint of you know, financial stability. No. The conditions of TPI are there, but we have not discussed TPI. We set up, you know, the framework, how to implement TPI. You know, I think that it was 2 or 3 years ago, and now TPI has not been, you know, a matter of discussion in our governing council meetings, because well, you know, first of all, the conditions were not in place at all, and the situation of the markets was very quiet. And well, we will continue, as I have said before, with the process of runoff and rundown of our portfolio. And now, you know, we will analyze, you know, the evolution of liquidity. The evolution of liquidity so far, we have not seen any sort of tension or stress there in terms of liquidity. And you know, next year we'll have the discussion about the structural portfolio. But well, the position of liquidity and the situation of liquidity, markets continue to be liquid, and so we do not have any sort of concerns with speculation.
Yeah. So if you allow me to tease you a bit, I would say there is a circular issue here, because the market says, well, the ECB has the backstop facility, so maybe we should not test it. But who knows?
Your guess, perhaps, you know, the perception of markets is that you know, the situation, you know, is even without you know, our instruments and our reactions, is perfectly well, is acceptable. Is you know, is moving in the right direction. But again, I said that fiscal is an important risk, and this is something that we have to take into consideration. Even though so far markets are very, very, very calm and very quiet.
And a question I have here, bringing to the last topic I wanted to ask you about, given your specific responsibilities within the Governing Council in terms of supervision of the banking system and regulation. What's your expectation looking forward when we will have the end of the QT? But through the monetary policy portfolio, the structural monetary policy portfolio, we will remain in excess liquidity. So how the fiscal stance will be and how the liquidity will be managed? Do you expect a return to a huge use of the MROs and LTROs, possibly very long LTROs? Or do you think that the liquidity in the system will be mostly managed through the structural monetary policy portfolio? And what's the implication for the banks?
Well, I think that it could be a combination of all these elements. We will have a structural portfolio in order to guarantee a minimum level of structural liquidity, let's call it that way, and simultaneously we'll have all our monetary policy facilities open, LTROs, and that there are different alternatives there. So I think that it will be a combination of both factors, but we have not discussed so far. I think that we are on the way to discuss that through the QT process, but we are not there so far. And and we feel comfortable with the level of liquidity now in markets, and simultaneously with the evolution of QT and the impact of QT and the reduction that are coming down.
Yeah. And in that context, how do you see, again, with the view of the implication for the stability in the banking system, how do you see the ongoing and prominent discussion about the stable coins versus the digital central bank digital currencies in a context where also banks complain about the huge amount of regulation, and so then saying basically that they see those competition coming in, but at the same time they have a very heavy regulatory framework with a lot of rules, a lot of bureaucracy. So first of all, how do you see the potential competition between stable coins and central bank digital currencies, and also what's the implication for the banking system?
Well, let me say something first. The situation of the banking industry in Europe has improved quite a lot. The European banks on average are solvent, they have enough liquidity, and they are much more profitable. This is something that we have to stress. I remember that before the pandemic, the return on equity of the European banks on average was something like 4%. Now we are clearly above 10%. The return on equity, and I think that this is something that is is positive, because it reinforces the solvency of the European banks, and this has been reflected on valuations. If you look at the price to book now, even is a little bit is hovering around 1, even a little bit above, and even we have been able to bridge the gap in terms of valuations that we had, for instance, with the US. So all in all, I would say that the picture of solvency, liquidity, and profitability of the European banks has improved, because I am responsible for financial stability in the ECB, and this is something that I think that we have. I think that is we have to highlight very clearly, because I think that is relevant. So that's the first point that I would like to make. Now, the picture of the banking industry in Europe is much better than it was 5, 6, 7 years ago. Always you will have, tail banks and these kind of things, no? But, on average, it's much, much better. Second, you refer to simplification. Well, here in the ECB, we have started, a sort of working group in order to try, to simplify. First of all, simplify doesn't mean deregulate. Simplify means to try to make the regulation that we have in place much easier in terms of, how you are meeting the conditions of this regulation. We are looking at 3 areas: the capital structure, reporting, and supervision. With respect to the capital structure, it's obvious that the present capital stack of the European banks, according to regulation, is very complex. So, we will have to produce and to release our recommendations before year end. The Governing Council will have to give the green light to those recommendations. But, for sure that one of the main recommendations will be, to try to simplify the number of buffers that now we have in the capital stack. Another kind of recommendation, for instance, is about proportionality. Not all the banks are equally big or equally complex. And that's why I think that, we can have, a different regime in terms of regulation and in terms of supervision for smaller banks that, are not systemic, let's call it that way. Another kind, for instance, the stress test. The present stress test, is very complex. And I think that, the process is convoluted and, well, we will try to simplify that. For instance, in terms of reporting, now, it could be, very good and very positive for the banks and for us and for the supervisors and for, the market authorities to have a single integrated, channel of reporting. Mm-hmm. And, something similar, we can do with respect to supervision. Well, these are the recommendations are recommendations for the legislators, mainly for the European Commission, because, some of the recommendations that we will make, we'll have to modify directives or regulations, and it's not up to us. It's what we call L1 regulation, level 1 regulation. And, this is something that if, the Governing Council gives the green light, that we'll have to release and to send to the European Commission before year end. And we will explain, the kind of recommendations that we are doing. We believe that these recommendations will be positive in terms of reducing, the, let's say, administrative burden without undermining or denting, the solvency of the banks.
Okay. And now that issue in terms of the competition, the upcoming competitions between the digital central bank digital currency, so the euro or the SOFR or versus the stable coins. How do you see the evolution of that issue?
Well, first of all, the digital euro is not a response to stable coins. Digital euro is something that we started some years ago, the analysis. And the digital euro is the digital evolution of the banknotes. Okay. In a world that is much more digital, you cannot pay, if you buy something online, you cannot pay with banknotes, but you will be able to do it with digital euros. So it's a means of payment. It's not going to pay any sort of interest rate. It's not going to be, it's not going to have any sort of return, as is the case of the banknotes. It's a digital format of the bank notes that we will be able to hold it, to have a wallet in our smartphones, as the wallet that we have now, in our jacket, piece of my jacket. So that's the intention. It's not going to replace physical banknotes. It's going to complement physical banknotes in a world that is more and more digital. And simultaneously, there is something that is obvious. There is a question of, let's say, autonomy in the means of payments. In payments now, if you look at the main companies, dealing with payments in Europe, they are not European domiciled companies. So I think that, in this world, there is a natural, and I think that there's an existential, decision in Europe that is to become more independent.
Mm-hmm.
And I think that, payments is one area that we have to become more independent. We referred before to defense, but we have to look, as well to the cloud or to the, to artificial intelligence. So these are, areas where Europe has to be, more autonomous and more independent than we usually were, because the geopolitical situation of the world is changing and is shifting.
And your feeling is that the EU leaders, so head of state and governments, this is a common view or a shared view, because the impulse should come from them first, right? Well,
but you can look at, the conclusions of the European Council, and it was, a unanimous support for the launching of the digital euro. But I repeat again, this is, I know that there are a lot of conspiracy, very strange, theories around. Well, it's something that we do not want to replace the banknotes. What we want is to complement the banknotes with a new format.
Can you, because there is a risk in terms of senior age, so then do you think, could we imagine a situation where there is a decision in Europe to ban the stable coins, or?
No, I don't think so. I think that we have, a regulation now that is, is maker. Well, we would, to like perhaps, to have a little bit more of clarity about what we call multi-jurisdiction and multi-issued stable coins. Stable coins, are now, the majority of them are US dollar denominated. Well, I think that some financial institutions in Europe, they have started, the process to launch their, euro-denominated stable coins. Is something that is positive, but the digital euro is not a response to that. And the digital euro is a response to the Italization of the world, and to give the European citizen and other instruments to make payments in online, for instance, and in a digital world.
Got it. Thank you. I have a last question, if you allow me. I should ask this question, even though I think I know the answer, but so basically someone asking that one of your colleagues this morning said that the consideration about the stance neutrality, policy space and financial soundness suggests that tilting the new structural securities portfolio towards short-term securities should be the answer. So have you discussed already those issues? What is your view?
Well, I know that some of my colleagues, they are, let's say, much more ambitious than myself, trying to advance, the next policy changes. I try to be much more prudent, perhaps because I am a little bit more humble, no? And I do not try to influence, the discussions in the executive board and in the governing council. But let me say something. We are not still there. We are not still there. Is something that we will have to discuss. I told you that we will combine, traditional monetary policy, facility windows with, a structural portfolio. I think that some of my colleagues, they have very concrete and particular views with respect to the structural portfolio. But I can assure you something. Nothing has been decided so far.
Okay, wonderful. Thank you very much. Again, it's always a pleasure to talk to you. I promise to stick to 1 hour because you are very busy. So thank you. It was for this very insightful and inspiring discussion. So I hope that everyone online enjoy the discussion as I did. And Luis, again, thank you very much, and keep in touch, and have a great day. Have all a great day. Thank you very much.
Thank you very much. Thank you very much. It has been my pleasure. Bye, Alain.
Bye.